Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison alongside Julie Hyman. Let's get you the three things that you need to know today.
First up, U.S. stock futures. They are falling as investors brace for the Trump administration's tariff announcement. Now, according to reports, President Trump and his team are still finalizing the size and scope of the new levies that he's slated to unveil this afternoon. Meanwhile, Treasury Secretary Scott Bessent said today's tariffs will be the highest they'll go, and that countries can then take steps to bring the tariffs down. That's according to reporting from CNBC.
Plus, tariff retaliation already underway. China's taken steps to restrict local companies from investing in the U.S., a move that could give Beijing more leverage for trade negotiations. That's according to Bloomberg. While China previously had placed tariff restrictions on some overseas investments over national security and capital outflow concerns, the new measures underscore tensions playing out between the world's two biggest economies as Donald Trump ramps up tariffs.
And we've got Tesla deliveries this morning. They'll show if the company had a brutal start to the year amid backlash against CEO Elon Musk. Analysts expect the EV maker to have delivered about 390,000 cars in the first quarter, according to estimates compiled by Bloomberg. That's down from the more than 460,000 that Wall Street had projected as of early January. This expected slowdown comes as the company grapples with declining overseas sales, vandalized showrooms, and paused production lines. Shares of Tesla are down 34% this year. U.S. stock futures falling this morning as investors await President Trump's tariff announcement later today. Joining us with the details, Fed correspondent Jennifer Schonberger. Obviously, there's a lot we don't yet know, Jennifer, but what do we know?
That's right, Julie. Good morning to you live from the North Lawn here at the White House this afternoon in an event in the Rose Garden being touted as Make America Wealthy Again. President Trump will unveil long-awaited tariffs on all countries as he aims to level the global trade playing field and bring manufacturing back to the United States.
April 2nd, 2025 will go down as one of the most important days in modern American history. Our country has been one of the most open economies in the world, and we have the consumer base hands down, the best consumer base. But too many foreign countries have their markets closed to our exports. This is fundamentally unfair.
It's still unclear what shape tariffs will take. All eyes will be on whether President Trump will follow through on his promise for reciprocal tariffs, essentially taxing other countries on their imports at the rate that they tax us, or whether we will see a more blanketed 20% tariff on all countries, a campaign pledge that the president often made. He has teased both in recent days. The president wants to use tariffs to bring manufacturing back to the U.S., raise revenue to pay for tax cuts, and use them as leverage to push other countries to lower their tariffs on U.S. imports or extract other policy changes like lowering fentanyl smuggled into the United States. There aren't expected to be any exemptions, and the tariffs are expected to go into effect immediately. The president has said if you build everything in the U.S., there will be no tariff. Senior White House Trade and Manufacturing Counselor Peter Navarro estimates Trump's tariffs could raise around $700 billion a year. But if tariffs are lowered through negotiation, that could lower revenue raised. The Tax Foundation estimates that a 20% blanket tariff would represent an average tax increase on U.S. households of $2,045. Today's tariffs coming after the president has already announced 25% tariffs on steel and aluminum, 25% tariffs on all car imports and car parts that are imported into this country, and 20% tariffs on China. No word yet on whether the president will resume tariffs of 25% on Canada and Mexico, which are set to kick back in today. Back to you.
Jennifer, thank you so much for breaking that down. I know you'll be at the White House covering everything we need to know all day. Well, details of President Trump's latest tariff round are scarce, but countries have already begun to prepare responses. China reportedly taking steps to bar companies from investing in the U.S., according to Bloomberg. The EU warning they hold a lot of cards when it comes to combating the new tariffs, and Canada promising retaliatory measures would follow, depending on what's announced today. Joining us now, Kellyanne Shaw, a partner at the global law firm Hogan Lovells and one of the key architects of the first Trump administration's trade policy. Kellyanne, can't think of a better voice to speak with today as we head into this so-called Liberation Day. I know when you worked with the president in 1.0, he talked a lot about the lack of fairness associated with tariffs. That drove his policy positioning. For today, does that objective of his equate to a maximalist trade approach or a country-specific approach that could include negotiations?
Yeah, good morning, and thanks so much for having me on. So I think the president has two primary objectives. So the first is about leveling the playing field. And I heard him talk about this multiple times during Trump 1.0, which is that it's not fair that other countries maintain higher tariffs, higher non-tariff barriers than the United States does. And so these tariffs that he's announcing today are an effort to really level the playing field, and they also give trading partners an opportunity to lower their barriers to meet the U.S., and that the U.S. would also lower theirs on a reciprocal basis. But the other objective is to really address this long-standing and persistent trade deficit, this $1 trillion trade deficit that is eating away at U.S. GDP growth. And I think the president's view is that if he puts tariffs in place, that will help overall balance the trading relationship. But of course, we don't know what the final measure is going to be. The White House has floated anything from 10 to 20% and even as high as 25% from former Secretary of Commerce Wilbur Ross yesterday. So we'll have to wait and see what ultimately the president decides to do.
Kellyanne, as somebody who was inside of these negotiations, I mean, what is this process, right? This is why does it take place in such a sort of open and public fashion, which seems to be much more disruptive for markets, for business decision making? As someone who's been inside it, like, why not just make the decision and do it? You know, what insight can you give us into that?
Yeah, and I've gotten this question a lot from various clients as well. And what I would say is I would have been more surprised if the president had arrived at a final decision last week. And that is because the president takes all of these decisions all the way up to the line and to the last minute when it comes to tariffs. And this will be the single largest tariff announcement in modern history. So it is not surprising to me that he is holding his powder until the very last moment. And part of the president's negotiating strategy is this intentional ambiguity. It is to leave trading partners guessing, to leave everyone uncertain as to what he's going to do. And when he does make that big announcement, it really will kick off this massive negotiation where other countries will have the opportunity to come to the table and see if they can negotiate down reciprocally. Now, I know that that negotiating strategy is effective when dealing with other trading partners, but it does give a lot of anxiety to businesses and to the markets who are trying to figure out what's going on. And what I would say there is that businesses and the markets aren't really the audience for this right now. I think some of those assurances and discussions and briefings will come after today's announcement. But right now, his messaging is to the American people and it's to trading partners.
Is it effective, Kellyanne? What evidence do we have that that is a successful negotiating tactic? Do we have? I mean, we have the tariffs that stayed in place from the first administration, but those weren't really negotiated back and forth upon to that high of a degree. I mean, what would you point to as sort of a success story of this negotiating tactic?
Yeah, and this is a tactic that the president has employed for decades. And what I would say from Trump 1.0 is the successful renegotiation of NAFTA, so the USMCA agreement.
Well, but it wasn't successful because now he doesn't like it and is throwing it out. So what I guess then the other question is what defines success?
Right, but I think it was incredibly successful for the United States, Canada, and Mexico. But what's unique about USMCA is it has this review mechanism. It is a living agreement. It was not designed to stay in place for forever. There is a requirement that all three countries get together and renegotiate and review that deal. And so I think that's what this is teeing up in terms of the president's pressure on Canada and Mexico to address some of these unfair trade practices. And we also saw the same playbook with China as well as South Korea with the chorus renegotiation. The president has a big job in front of him. He is setting out not just to negotiate one or two relationships, but the U.S.'s economic relationship with every country on earth. And it will come down to implementation to see whether or not the administration is successful. But my point is, I'm not surprised that this is the tactic that the president is taking.
If the president does push us into a recession, which so many sources we speak with say this policy has the potential to do, is that something that makes him more amenable to negotiation in your view?
Yeah, I think the administration is trying to land this shy of a recession, right? So they've talked about tariffs being part of their broader economic strategy, which includes tax cuts, deregulation, energy diversity. And they really do have to land all of these things for this to work. This is a big swing. This is unprecedented in terms of modern U.S. history. And so the administration has a really big job in front of it to make sure that we stave off recession, that we end up in a place where Americans are better off a year from now than they are today. And so I'm watching very closely to see exactly how the president messages this, because again, I think this is an uphill battle for him.
Do you think he knows right now what he's going to announce at 4 p.m. today?
I do.
All right, Kellyanne, thank you so much for joining us. Appreciate it.
Thank you for having me.
The impact of President Trump's tariffs has already begun to show up in recent manufacturing data. Economic activity in the sector contracted in March as prices paid accelerated due to steel and aluminum tariffs. On the back of that recent deterioration, our next guest says he anticipates a pullback in CapEx spending and flat earnings growth in the near term. Joining us now, Michael Darda, Roth Capital Partners chief economist and macro strategist. Michael, presumably you just heard our discussion here with Kellyanne about what President Trump here is trying to achieve, and presumably the cost that he's willing to bear, or that he's willing to have the country bear to get there. There's a lot of talk about whether today is going to be a so-called clearing event. Is it going to be sort of the worst that things are going to get with the tariff announcement this afternoon? What do you think?
Well, I guess we'll just have to see. I mean, it's obviously a fluid situation where we've been in this environment where we have tariffs on, tariffs seemingly off, and then tariffs on once again. But there's a ratcheting effect. Trump 2.0 has already gone much, much further and more broad-based with the tariffs than what we saw in the first administration. So I think the idea that this is all a ploy or a negotiating tactic or some kind of a bluff that will quickly reverse has been sorely, sorely mistaken.
So then where does that leave the Federal Reserve, Michael? And I ask because we saw the greatest number of rate cuts getting priced in for the year after some Fed speak this week, 3 cuts for the year. But if we see tariffs fueling more inflation, how do we possibly get to that?
It puts the Fed in a real predicament because the tariffs will act as an adverse supply side shock, meaning that they will temporarily raise inflation and reduce real economic growth. And the Fed's dual mandate tells it to respond to weaker real growth with rate cuts, but higher inflation with rate hikes. So markets are pricing in rate cuts, and those expectations have stepped up with the stock market correction and soft macro data at the margin. But the risk here is that if the economy is weakening and the Fed hesitates on those rate cuts, you could have a situation where the Fed falls behind the curve and the soft landing that we've been in for essentially 2 years slips away. Right now, tracking estimates for private sector real final sales, so basically looking at consumption and investment, running at just 0.4 of a percentage point for the first quarter. That's after an 8-quarter average of just above 3%. So it already looked like the economy was slowing down pretty significantly in Q1, and we really haven't seen the full brunt of effects from tariffs that are coming down the pike. So, these headwinds, I think, are an important reason that, that markets have been tripped up this year. Tripped up because we came into the year with markets wrongly assuming that Trump was bluffing on tariffs and that somehow magically deregulation and other tax reforms would somehow offset the sting. And it's looking like that was a very bad assumption indeed.
Michael, also at the beginning of the year, when we were talking to a lot of strategists, even when the tariffs started to look more probable, a lot of people were saying earnings growth this year is going to be fine, and that's why stock returns are going to be fine. I was intrigued in your recent note when you looked at an earnings model that you all have developed that shows maybe earnings aren't going to be as fine as we thought. Can you walk us through this?
Absolutely. So, we're seeing some of the leading indicator data really roll over here. So we have a model that looks at new orders from the ISM Manufacturing Index, highly correlated to the trajectory of S&P 500 earnings growth and capital spending. And then the model also uses high yield debt spreads that change on a year-to-year basis. So right now, with the new orders component of the ISM index sinking for the last 2 months and high yield spreads widening, it looks ahead, 6 to 9 months in terms of the earnings trajectory. So the expectation of the model now is for a flat trajectory for earnings, where analysts came into the year expecting 14% earnings growth. So if you have high stock market valuations, which we did at the beginning of the year and still do have despite the pullback, and those valuations are on earnings estimates that are 10 to 14% too high, that's a real problem. And I think we're seeing the result of that now with this downside volatility.
All right, Michael, thanks so much for joining us. Appreciate it.
My pleasure.
We want to bring you some breaking news. Tesla falling as first quarter deliveries come in well below estimates. Yahoo Finance's Praz Subramanian is here now with more on the automaker's start to the year. Praz, what do we know from these numbers?
Yeah, big delivery miss here. Kind of a, I don't want to say shocking, but it's a big miss. 336,681 deliveries versus 390,000 or so estimated. The company produced 362,000 vehicles and deployed about 10.4 gigawatts of energy deployments. But they had a statement. They said, while the changeover of the Model Y lines across all 4 of our factories led to the loss of several weeks of production in Q1, the ramp of the new Model Y continues to go well. The company said in a statement. Well, that is true that the new Model Y came out in March. You lost some of those, the changeover. People weren't buying the old Model Y, so they're waiting for the new one potentially. But still, this is sort of indicating these demand concerns are materializing. We're seeing them in this recent Q1 report. I mean, this is a miss compared to last year, Q1, I believe. We've been noting the fact that sales in places like Europe, China, and even in the US have been coming down in terms of registration data that we've been seeing trickling through. So we're finally seeing that materializing here in Q1. Q1 is usually a weaker period for them in terms of sales, but this particular number is not great for Tesla. And you're seeing the stock down about 5% in pre-market trading.
And also, even if it had met that higher estimate, it still would be less than BYD in the quarter, right? So BYD continues to surpass it in the number of deliveries.
Yeah. I mean, it's exactly.
I think they were, 416,000 just in their EV business, and they make other types of cars. Right.
I mean, they're doing quite well there in China. I mean, they also have EVs that cost $15,000, right? So they have a different sort of customer and product offering. But you're absolutely right. Last year, Tesla barely squeaked out an EV win versus BYD. This year, it doesn't seem like that's going to happen. If you're a Tesla investor or analyst that's bullish on the stock, you're hoping to see that new, cheaper EV come out to hopefully boost sales in a number of those key regions, potentially China. You're also hoping to see more on the autonomous deployment that Musk's been talking about. Apparently, also Musk has been talking about Optimus robot stuff. So trying to distract from what's happening with the key core auto business, which right now is sort of slowing down just a bit here in Q1.
What do we know about how much this problem can be fixed through those other product offerings, the cheaper Model Y, for example, versus this being rooted in some sort of backlash to Elon Musk, which can't be fixed through a new product?
I mean, that's the big question people are asking is, as long as Musk stays first and foremost up front with Doge, does that kind of keep this weight on business and also the stock? Will that new cheaper EV help boost sales no matter what the politics of Musk are? Will Musk eventually leave the White House and go back to running the auto business, which Trump hinted at a couple of days ago? So I think that those are all this mix of questions about demand, about the Tesla brand image, new products, deployment of autonomous in Austin and places like California are all sort of in the mix for Tesla right now as investors sort of have to parse through all of it to see, hey, is this stock a buy right now? Is it a challenge company? That's the sort of the outlook right now for the company.
And even if he goes back, has the damage already been done?
Right.
I think is a question worth asking.
People tend to forget in America, though.
That is true. We have short memories.
Yeah, exactly.
Praz, thank you so much. Really appreciate you breaking those numbers for us. Coming up on Morning Brief, we'll count you down to the opening bell on Wall Street as investors brace for Trump's tariffs, plus how the levies are impacting NVIDIA and the rest of the semiconductor names you need to know, and a check-in on automakers as the industry braces for tariffs. We'll discuss that and more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. We're taking a look at NVIDIA and European auto stocks. First up, NVIDIA, watching those shares closely, moving down about 2.5% as investors weigh the impact of tariffs on the semiconductor industry. President Trump has previously said he would impose levies on semiconductors down the road, is how he has referred to it, without giving an exact time frame. And while there is a lot of conflicting reporting about what the tariffs announced today will be, one of the things that does seem to be off the table is so-called sectoral tariffs that might affect semiconductors. However, semiconductors specifically, I should say. However, obviously, if there are universal tariffs or tariffs on China or tariffs on other nations, there still could be a knock-on effect, not just for NVIDIA, but for semiconductors more broadly.
And we also do have a little bit of insight into what the retaliation might look like globally, with China announcing this morning, at least according to Bloomberg, that they are pushing Chinese firms to not invest into the United States. Is that perhaps a signal of more of this tit for tat coming moving forward? And what does that start to do to some of the chip names, even withstanding any geopolitical tensions that we could see with China and Taiwan, also potential risk here, just a lot of potential tension globally.
Right. And to be clear, most of NVIDIA's chips are made not in China, but in Taiwan by Taiwan Semiconductor. Obviously, Taiwan Semiconductor is planning to expand its manufacturing capacity here in the U.S. as well, which could take care of some of that, but definitely not all, because it has an enormous amount of production capacity at home in Taiwan. But still, the other thing to note is that as we've gotten tariff headlines, whether or not the large cap tech names are directly affected, they have moved, right? They have been that risk barometer time after time when we get those headlines, and NVIDIA is included, but it really extends to many of the other mega cap tech names as well.
NVIDIA, perhaps the biggest of them all when it comes to movers as of late, though we have seen, obviously, Tesla is also one of the biggest decliners, certainly this morning as well.
Special case.
The Mag 7, that is a special case, exactly. All right, let's talk about European auto stocks falling as President Trump's tariffs on auto imports are set to take effect. Trump announced last week that he would impose 25% tariffs on cars and car parts that are made in North America. You can see here those European automaker stocks moving to the downside this morning. And what's interesting is we did have Ursula von der Leyen talking about how they hold some cards that they can utilize in order to engage in a tit for tat with the United States. Is that something that causes more pain to some of these automakers moving forward? Is something that will be interesting to monitor. On the flip side, we do have some negative news about Tesla this morning. What does that mean in terms of where people are getting their cars? Maybe there's some read through there that could be a lift to some other automakers. We'll just have to see in the earnings prints moving forward.
Yeah, and again, of all the things that we don't know, we do know there are auto tariffs, and we do know they're about to go into effect.
Yes.
So we know at least these European automakers and the U.S. automakers, for that matter, are going to have to pay these 25% tariffs on parts and cars that they are importing into the U.S. So we've been watching the European automakers. I'm keeping an eye on the U.S. Automakers as well. Both GM and Ford are down a little bit this morning, but could they end up being double tariffed? Some of the European automakers in particular. We don't know. We'll find out at 4 p.m., hopefully.
Right. Well, and I guess that's also a question. Do we actually get any clarity today, or is it just the start of a long process of negotiations that could take months, could take years, potentially? That's what Kellyanne had said earlier as well. Adam Johnson talked a little bit about this earlier this week with me, and he said that if investors really believed that auto tariffs were going to be as bad as the administration is maybe saying right now, there would be a bigger sell-off in some of those auto stocks than we're seeing.
That's probably true, but what they believe and what the reality is might
not always
be two different things. They might not have priced in that worst-case scenario, but that doesn't mean the worst-case scenario is not happening.
Right.
The markets don't always know.
Right. The markets don't always know. If they did, then investors would be very wealthy all the time.
All the time.
Exactly. And what would we talk about? So, all right, we're going to have all your markets action ahead, so stick around for more. You're watching Morning Brief. That's your opening, well, we're about 10 seconds away from your opening bell on Wall Street, but you are looking at the New York Stock Exchange and the NASDAQ here. Let's take a look at how markets are trading this morning. No surprise to see markets in the red as we are heading into the president's so-called Liberation Day. We are expecting to hear some clarity at 4 p.m. from the Rose Garden. We will bring you all of that news that you need to know throughout the day today. Taking a look, though, at where your market is as we do open up across Wall Street here. You're looking at the S&P 500 down about 1% this morning, seeing a little bit of that selling pressure coming in. It's looking like the NASDAQ might be positive at the moment, though we might be a little bit delayed here this morning as we are waiting for the market to open. Though it does look like the NASDAQ has turned positive. Nope, it is down this morning as our boards are adjusting here. Let's get over to Yahoo Finance's Jared Bickley for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. Lots in flux. I'm going to try to unpack what's going on here. I'm going to start with a year-to-date chart of the S&P 500, and this is important because we just had what's potentially a bear trap. That's when we exceeded the lows from earlier in the month, and then we kind of rocket higher during the day, and then we closed up yesterday, but not by a lot. And usually you want to see more momentum off of these moves. And with the level of uncertainty in the markets right now, and we can see this in the VIX, we could be in for kind of a rocky day here. Hopefully we get some clarity on things at 4 p.m. today, but that is not assured. And before I go, I want to mention, before I move on to the VIX, I want to mention that the Russell 2000 futures would be down 7 days in a row if they were to be down today. Now here's the VIX. It is up to 23.5, and it has been holding at very high, not very high levels, but relatively high levels. You can see it's taken a few days here to come off of those lows. And all in all, the VIX seems very comfortable hanging out in this area above 20. When this happens, that just kind of reflects the uncertainty that we've seen that's become baked into the market. We want to see this come back down below 20 and ideally below 18, these recent lows down here. And I recognize what a mess I've made of the chart. So here is a 10-year. We are looking at the lowest close if we were to close at current levels since October. This is a year to date, so we'd have to go back a couple months before that. That's important. Lowering yields, sometimes that means risk-on flavor to the market. Not recently. That's kind of anticipating the potential for more Fed cuts that are necessary. And when the Fed have to cut from behind the 8 ball, that usually means a little bit more risk in the market. And that's kind of what we're seeing. Only Staples is positive right now. I want to get a 3-day total so I can look, and Staples is still the leader there. Utilities in second place, energy in third, then real estate. That is a very defensive setup. What's missing is in healthcare, and healthcare just had a really bad day for biotech, so that's weighing on that sector this week. And I want to go back to an intraday, and then I'm going to take a look at the Mag 7. Now, the Mag 7 charts have been tracking closely what's happening in the NASDAQ. They also had that bullish reversal that I was talking about in the S&P 500, but that is under pressure right now. So I'll give you NVIDIA as an example. Here's the year-to-date chart, and here we can see a very similar chart to the S&P 500, but we're just hanging out by these lows here, and we get another close below these lows, and a lot of the other Mag 7 charts are similarly situated. We could see a wave of selling, so that's something to watch out for. I want to move on to the metals complex here, and I have just been seeing a lot of action in not only the precious but industrial metals. I've been talking about the record highs in not only gold but copper, and here we're seeing gold. It would be set. It looks like that's another record high here. It would definitely be set for a record close, and we are now up to 3163.80. Gold futures have advanced a lot this year. That is a lot for gold to do. Some of the commentators I've been following on X suggest that it might be time for a pause, but the technical is still really bullish here. I'm going to close with copper. See if we can get a year-to-date chart up there. Maybe not participating with me here, but we are seeing copper, at least that quote there says it's up 50 basis points, about 0.5%, and that's probably good, if not close to another record high. So really interesting to see this dynamic of risk markets under pressure, while some of these other markets like Dr. Copper at record highs. Well, I'm not going to leave the Dr. Pepper talk for another day.
And go get a Dr. Pepper.
Thank you.
And then we'll talk Dr. Copper. Thanks. Appreciate it, Jared. It's time now for today's strategy session. It's a survey, and we're watching a survey of C-suite executives that shows that corporate confidence is falling. The chart here shows what CEOs expect the economy to be like 1 year from now. It's down to levels not seen in years as investors brace for the fallout from President Trump's tariff policies. Let's get the view from inside the C-suite and bring in Scott Sperling, THL Partners co-CEO. Scott, thank you for joining us.
You're very welcome.
There's been a lot of talk about sentiment right now, both among consumers and among CEOs. You guys have a broad swath of companies in your portfolio from different types of industries. How's everybody feeling right now?
Well, I think uncertainty is the word of the day, the week, and the month. We came out of, I would say, almost a euphoric set of feelings because of very strong fourth quarter performance. I think there's continues to be a lot of excitement about deregulation and many of the other policies of this administration. The uncertainty is really centered on the issue we've all been talking about, which is what is the impact on the cost structure of a wide range of businesses from the tariff policy that we're going to hear a lot more about today. But I suspect that this is just the beginning, that there is going to be a lot of changes over the course of not just the next 30 days, but probably over many, many months. And it's those levels of uncertainty that I think is causing the confidence to sink that you see. And also, if you think about it from a consumer's perspective, you read a lot, you hear a lot about the fact that these tariffs may be causing significant consumer level inflation. And so I think it's translating into a set of very hard to read numbers coming out of the consumer spending set of metrics, where you might see some significant bumps up as people try to buy in advance of what they view will be an highly inflated set of prices down the road. But consumer confidence continues to be somewhat shaky as well.
Scott, something that you mentioned is that there is still this thought that deregulation is coming and will be helpful. Tax cut extension is still coming and will be helpful. Why is that view intact, given the messiness of this tariff situation and the seeming indifference that the president has expressed about the costs that are clearly being incurred from that strategy?
Yeah. Well, I think that the fact that he has expressed what you've called indifference, which I think is an indifference to the very short-term moves in the market, which that is unusual for him. That is not something that I think people typically
but it doesn't even
believe that he does.
If I may, it doesn't even seem to be just about the short-term moves in the market.
Well, I do think. I was just going to say, I do think that they are trying to articulate the fact that there will be significant positive outcomes from having a set of tariff policies that they believe will both level playing fields, but also drive significant private sector investment back into the United States and allow them, many of them have been articulating the thought that some level of permanent tariff is a good substitute for taking money out of the pockets of business and individuals through the typical tax code. And that if they can do that, they can take dollars from the government that are relatively inefficient and put it back into the private sector. That I think is a theory that many of them have latched onto, but not everyone in the administration. So I think we're still seeing the struggle between people who believe tariffs should be a short-term negotiating strategy to level a playing field, and those that believe a permanent tariff of some level is structurally a better answer than higher taxes.
And to some degree, we're already seeing evidence that things are different this time around. We have news of China blocking off investments into the United States, for example,
yes.
Potentially allies abroad teaming up against the U.S. To what extent is that a headwind that you are concerned about?
Well, I do think that there's been national security concerns about Chinese investment in the United States for a while, so the level has not been significant. So I'm not sure that when you kind of look through the numbers is that significant. But I think it is a signaling that the Chinese are sending about the way that they might respond to this. And I think we all know that the Chinese are highly vulnerable to this policy because we are their biggest market. And they do depend on exports as the key driver of their economic health. And so if anyone is going to be adversely affected in a scaled way, it will be the Chinese. Now, there are lots of reasons to believe that there are going to be a lot of mistakes made as they implement this policy. We've probably already seen the back and forths about the righteousness of the tariffs with Canada, for example, and what the policies are with Mexico. So I think that we're going to have to wait quite a while to see whatever the longer term, more stable set of policies from a tariff perspective. And that means continued uncertainty.
So how do you invest in that environment then, Scott, if uncertainty is the only certainty?
Very carefully. I think you have to look at the fact that this may be a very difficult year. I am hearing from CEOs across a wide range of industries, mostly friends of mine, of larger companies, that revenues were okay for the first quarter, but bookings are really difficult, which means that as you look forward, this is probably going to be a more difficult year than anyone assessed coming into the year, and that analyst revisions are more likely to be down than they will be to be up. Companies have to figure out how they're going to respond to what may be higher input costs that they're not going to be able to work through in terms of the margin structure of their business as it currently exists. So they have to figure out, how do we get more productivity, how they change supply chains, and what and how much they can pass on to customers. You're already seeing some of the stories about Walmart really pushing back on their Chinese suppliers, even though the Chinese government has threatened them about this. But Walmart basically saying, you're going to give me a 10% cut, or we're just not going to buy from you. So we're going to see how much can be absorbed outside of the U.S. consumer and how much is going to come back both to the U.S. consumer, but also to businesses, because a lot of tariffs may affect intermediate goods or inputs like aluminum and steel that cross so many different kinds of business to business and business to consumer manufacturers and providers.
Scott, how is all of this translating to what you are doing in your business? Are you holding off on sort of aggressively looking for acquisitions right now? Or because prices have fallen, is it a good time? Or are you more focused on sort of the management of your existing portfolio and riding out this period?
The sectors we invest in, healthcare technology and financial technologies and services, tend to be less directly affected by the tariffs, but obviously our customers could be affected. So, we're looking through to that. We have invested, and I think a lot of people in our industry have been looking to invest in companies that actually help this customers drive higher productivity. So we're looking at technologies and services that can help offset the negative impact of tariffs, higher tariffs, to a lot of our customers. Now, that doesn't mean there won't be bumpiness, and it doesn't mean that CapEx isn't going to get affected. And in fact, in many ways, it may be frozen for a while. We haven't heard of things going away or being canceled, but there's certainly more caution on the part of lots of businesses for all the reasons we've been discussing. And that translates into perhaps waiting a bit or holding back on exactly where they're going to be investing in infrastructure and other forms of CapEx. But the one area that we think that there's going to continue to be significant demand will be for those things that help the productivity of their cost structure. And so things like automation, software, and things related to the ability of generative AI to provide automation for things that we haven't historically automated. Those we believe are quite good areas. Lots of choppiness in life science because of everything that we've read about. But we do think that is one of the industries that has made America great. It has been one of the most important industries for the United States. We believe that when the administration fully looks at it, there is going to be a set of perhaps maybe I could call it corrections to some of the early pronouncements about what they're doing in terms of the funding of research, because it is such an important industry for the United States, for the people of the United States and globally. But it happens to be an area that is very large that we tend to be the dominant player in.
Yeah.
So we think that'll be recognized.
All right, Scott, thank you so much. Great overview and a lot to talk about. Hope you come back soon so we can chat more. Thank you.
Thank you very much. Take care.
Coming up, we're talking to a former presidential health advisor about why he calls the recent cuts at the health department that Scott was just discussing devastating for institutional knowledge. That when we come back. Pharmaceutical and biotech stocks have taken hits this week between uncertainties surrounding the president's plans for broad tariffs and staff cuts at the Department of Health and Human Services affecting the FDA, CDC, and more. Our next guest says these cuts could be devastating for institutional knowledge at the department. Dr. Zeke Emanuel is the University of Pennsylvania's Vice Provost for Global Initiatives, also working under President Biden and President Obama. Dr. Emanuel, great to have you in here. You say the notion that this is an effort for efficiency is false. Explain.
Well, if you look at the cuts, 20,000 people is the cut being proposed at HHS, actually being implemented as we speak at HHS. And that is purported to save $1.8 billion. If you just figure what's the salaries and benefits for 20,000 people, it turns out it's about $1.8 billion, which tells you very clearly there are no efficiencies being gained because they're not anticipating reducing the budget. I would also mention that the $1.8 billion in savings supposed is 0.01% of the HHS budget. It is not serious. On the other hand, the people you're cutting are the people who've been there a long time, who understand how programs work, understand where the best investments are, who the best researchers are, where we can actually improve the country's healthcare system. Look, one of the areas we're cutting is chronic illness. RFK claims that chronic illness is one of his top priorities, and yet we're undercutting our ability to fight things like hypertension, diabetes, and obesity, and intervene also on chronic infectious diseases. This is not the prescription for making America healthy again.
Dr. Emanuel, sort of related to that, what do you think are the biggest risks to Americans from some of the cuts that we're seeing? Is there any sort of urgent risk that could be incurred from these cuts?
Well, you're looking at a big measles outbreak with a large percentage of the people kids contracting measles being hospitalized, 2 deaths, and it's spreading. That's one immediate risk. There are other, we just had a cruise ship with norovirus. There's other risks that are more midterm. Those are risks of uncontrolled diabetes, uncontrolled hypertension, and other chronic illnesses. And then there's the long term. You just got heard. There are drugs and therapies that we won't discover. There are also going to be slow approvals at the FDA. You get rid of something like over 3,000 people at the FDA looking at drugs and vaccines and other things, and you are going to slow up that process, which means it'll take longer to evaluate new products, and that is going to make it much later for Americans to get therapies. The last thing I would say is there's been a wholesale attack on mRNA, I think because it's associated with Tony Fauci, even though the president created warp speed and did a great job, actually, of fast-tracking that vaccine. But mRNA is not being used just for vaccines against infectious diseases like COVID or flu.
Yeah.
We're talking about mRNA vaccines against cancers. So
Right.
you may be able to treat your cancer with a shot rather than chemotherapy in the future. We're just not going to pursue that. That is devastating to the country.
And Dr. Emanuel, I know that you are obviously very familiar with this up close, given your work during the COVID-19 pandemic. What happens if we get another pandemic and all of our health officials have been fired?
Well, it's not just our officials, it's whether we'll actually know, because the monitoring systems that we've had in place, the local and state public health boards, the funding for that is being pulled. We may walk into it blind, not know what we're doing, and not being able to control it. And I think this is a serious issue, especially since we have H5N1 percolating out there, and we really need to track it carefully to sequence all the genomes so that we know if it's evolving and potentially transforming. But that's not the only serious infectious disease out there. COVID came out of nowhere, and we know that there are many other illnesses that could threaten the country.
Certainly. Now, I think part of the stated purpose or the stated goal of this administration generally, not just in healthcare, is to get the private sector to take on some of the things that the public sector has been doing, that the government has been doing, funding research, for example. Is there a place here for corporations to step in to do, at least fund some of this research, if not do some of these other functions?
That just misunderstands the ecosystem of biomedical research. Look, a lot of basic biomedical research, like the Human Genome Project, like the development of gene therapies, like the development of CAR T therapies, that happens in labs funded by the government. Then it's brought to a collaboration between universities and private industry and the drug companies and the biopharmaceutical companies, where they further develop it, refine it, make adjustments, and then they test it in large numbers of people. Let's face it, the drug companies, I sometimes criticize them for not doing enough research, but they're doing a lot of research, billions, tens of billions of dollars of research themselves, mainly in the clinical sphere. They've sort of outsourced the basic science and the preclinical trials to university labs and startups. So there is already a lot of research, and they are not going to fund the basic research that happens at universities because it turns out to be a common good. It makes no financial sense if I, as a company, spend money where other companies can gain an advantage from my research. That's just not how it goes in the world. The ecosystem is such that universities do basic research, the drug companies come in to really do the clinical research and develop that drug and market that drug and distribute that drug and go through the complicated FDA process. That ecosystem, you take one leg out and it's going to fall down. And I think that was the warning of your prior guest. This has been the place the United States has been number one in for decades. And now we're totally the programs and policies recommended, the cutting of the research, the threat to university endowments are really going to undercut that lead that the United States has.
Yeah. Dr. Zeke Emanuel, thank you so much for your perspective. We'll be right back.
Thank you.
Thanks.